China just removed $500 billion out of America's financial foundation. And I'm not talking about stock markets or trade deals. I'm talking about something far more consequential. China has systematically dumped over $500 billion in U.S. Treasury bonds, the very instruments that keep this country's spending machine running. This happened quietly, deliberately, over months and years. And most Americans have no idea it even occurred. Now, I've spent considerable time analyzing economic shifts like this, and I need to be direct with you today. What I'm about to explain is bigger than any political headline you've seen this month. It's bigger than any tweet, any rally, or any cable news argument. This is about the fundamental structure of American power, and the cracks that are now visible for anyone willing to look. If you stay with me through this breakdown, you'll understand something that maybe 1 in 100 red people truly grasps. Why the next decade is going to feel very different from the last 5. Let's get into it. So, what actually happened here? Let me give you the simple version first, then we'll go deeper. China used to be the largest foreign holder of U.S. Treasury bonds. At its peak, China held more than $1.3 trillion in these securities. To put that in perspective, that's more than the entire annual economic output of countries like Mexico or Indonesia. Today, China holds less than $800 billion. That means China has removed over $500 billion from America's debt system. $500 billion that used to fund U.S. government operations, military spending, and budget shortfalls simply gone. Now, when I say Treasury bonds, I want to make sure you understand what we're really talking about. These aren't abstract financial products. They're essentially IUS from the U.S. government. When America spends more than it collects in taxes, which it has done every single year for over 4 decades, it covers the gap by selling these bonds. Foreign countries buy them. And for a long time, China was the biggest buyer of all. Think of it like a credit card, but instead of a bank extending you credit, foreign governments lend you money by purchasing your debt. And just like a credit card, there's an assumption baked in. Someone will always be willing to lend. But what happens when your biggest lender says, "Actually, I'm not interested anymore"? That's the situation we're now facing. And here's what makes this particularly significant. China didn't panic sell. This wasn't a rushed decision made in crisis. The data from the U.S. Treasury Department shows a clear, steady pattern. Year after year, month after month, China has been methodically reducing its exposure to American debt. This was strategic, calculated, and it sends a message that capitals around the world are now receiving loud and clear. But to truly understand why this matters and why it should matter to you personally, we need to rewind about 50 years and look at how this system was built in the first place. In 1971, President Richard Nixon made a decision that fundamentally changed how the global economy works. He took the United States off the gold standard. Before that moment, dollars were backed by actual gold. If you held dollars, you could theoretically exchange them for a fixed amount of gold held by the U.S. government. This created discipline. The government couldn't just print unlimited money because it had to maintain gold reserves to back up that currency. Nixon ended that system. And what replaced it was something economists have debated ever since. Here's how it works now. And I want you to really absorb this because it explains almost everything about American economic power. After the gold standard ended, the dollar didn't collapse. Instead, it became what's called the global reserve currency. This means that countries around the world hold dollars as their primary savings. They use dollars to trade with each other. They price oil in dollars. They settle international transactions in dollars. Why? Because the United States had the largest, most stable economy. Because the U.S. military protected global shipping lanes. Because, quite simply, everyone agreed to trust the dollar. And when everyone trusts something, it becomes the standard. Now, here's where this gets interesting. Being the world's reserve currency gives the United States an extraordinary advantage. Some economists call it an exorbitant privilege. I think that's actually an understatement. Think about what this means in practice. The United States can create dollars, literally create them, and the rest of the world will accept those dollars as payment. Every country needs dollars to do business internationally. They need dollars to buy oil. They need dollars to build reserves for emergencies. So, the demand for dollars is essentially built into the global system. This allows the United States to do something no other country can do: spend vastly more than it earns without facing immediate consequences. Look at the numbers. The United States represents less than 5% of the world's population. Yet, it consumes close to 25% of the world's resources. How is that mathematically possible? How can 5% of people use 25% of the stuff? The answer is the dollar system. America runs massive trade deficits year after year. It buys far more from the world than it sells. And normally that would be unsustainable. If you or I spent more than we earned every month, eventually our credit would run out. Banks would stop lending to us. We'd face real financial consequences. But the United States has been running trade deficits for over 40 consecutive years. And the consequences never seem to arrive. Why? Because other countries kept buying American debt. They kept lending to America by purchasing those Treasury bonds we talked about earlier. And the biggest lender of all was China. Here's how the cycle worked. American consumers bought Chinese products, electronics, clothing, furniture, everything. Those dollars flowed to China. The Chinese government then took those dollars and invested them back into U.S. Treasury bonds. So, the money made a circle. Americans bought Chinese goods and China used the payment to fund American debt. Some economists called this a mutually beneficial relationship. Both sides win. Said, America gets CIPS and cheap financing. China gets access to the world's largest consumer market. But that description glosses over something important: power. By holding over $1 trillion in American debt, China was deeply entangled in the U.S. financial system. If the U.S. decided to freeze those assets to impose sanctions to weaponize its financial infrastructure, China would be vulnerable. And for years that might have seemed like a distant theoretical concern until it wasn't. February 2022, Russia sends troops into Ukraine. Within days, the Western response is unprecedented. Not just in military aid, but in financial warfare. The United States and its allies froze approximately $300 billion in Russian central bank reserves. Let me repeat that number so it sinks in. $300 billion. Frozen assets that Russia had accumulated over years, held in what they believed were secure international accounts, suddenly inaccessible. Now, whatever your views on Russia or the conflict in Ukraine, step back and consider what this moment revealed to the rest of the world. It proved beyond any theoretical debate that dollar-denominated assets can be weaponized. It showed that if you hold your national savings in dollars in U.S. Treasury bonds and Western financial institutions, those savings exist at the pleasure of Washington. Cross certain lines and that money can disappear overnight. Now put yourself in Beijing's position. You're holding $800 billion to over $1 trillion in U.S. Treasuries. You've watched the United States designate you as its primary strategic competitor. The Pentagon openly identifies China as its top concern. Washington is building military alliances throughout Asia explicitly designed to contain Chinese influence. Trade restrictions are tightening. Technology transfers are being blocked. There's constant discussion about defending Taiwan with military force. And the whole time you're sitting on $1 trillion that this same government could freeze with a single executive order. What would you do? The answer is obvious. You would reduce your exposure, you would diversify, you would find alternatives. And that is exactly what China has been doing. But here's the part most people miss. China didn't just start selling bonds. It built an entirely parallel financial infrastructure. And it's been doing this for years. First, there's CIP, the Cross-Border Interbank Payment System. This is China's alternative to SWIFT. If you don't know what SWIFT is, it's essentially the messaging network that banks use to transfer money internationally. Almost every major international transaction flows through SWIFT in some way. And critically, the United States has significant influence over SWIFT. It has used that influence to cut countries off from the global financial system. Iran, Venezuela, Russia, North Korea. With CIPS, China created a backup, a way to move money internationally without depending on systems that Washington can monitor or disable. Second, China has been aggressively promoting the yuan for international trade. It has established currency swap agreements with dozens of countries. It's opening yuan clearing centers in major financial hubs around the world. More and more of China's foreign trade is now invested in yuan rather than dollars. And third, and this is crucial, China has been accumulating gold. Now, China doesn't publish precise figures on its gold reserves, and that opacity is intentional. But every credible estimate suggests China has been one of the world's largest gold buyers for years. Thousands of tons of physical gold. Why gold? Because gold has a property that Treasury bonds lack. It cannot be frozen. It cannot be sanctioned. It cannot be printed into existence. It exists outside any government's control. If tomorrow the United States froze every Chinese dollar asset, that gold would still be there, still valuable, still useful. It's the ultimate hedge against American financial power. So when we see China selling Treasury bonds, we're not just watching a financial transaction. We're watching a country deliberately, systematically extracting itself from American financial control. Now, if China were the only country doing this, we might dismiss it as an isolated strategic move. But China isn't alone. Not even close. Japan, historically the second largest holder of U.S. Treasuries, has also been reducing its positions. Saudi Arabia, the country that essentially created the petrodollar system by agreeing in the 1970s to price oil exclusively in dollars, is now publicly discussing alternatives. Saudi officials have talked about accepting yuan for oil sales. 10 years ago, that would have been unthinkable. Central banks worldwide are buying gold at levels not seen in decades. Last year alone, central banks purchased over 1,000 tons of gold. They're converting paper assets, dollar assets into physical metal that no government can freeze or devalue. And then there's BRICS, Brazil, Russia, India, China, South Africa. These 5 countries now represent a larger share of global economic output than the G7, the traditional club of wealthy Western nations. BRICS members are actively discussing the creation of a shared trading currency. They're building development banks that operate outside Western control. They're establishing trade relationships that bypass the dollar entirely. Saudi Arabia has expressed interest in joining BRICS. So have Egypt, Ethiopia, Iran, and the UAE. The organization is expanding precisely because countries see value in having alternatives to dollar-dominated systems. Here's another data point that rarely gets attention. According to the International Monetary Fund, the dollar's share of global reserves has declined from over 70% 2 decades ago to roughly 58% today. That's a meaningful drop, not a collapse, but a clear trend. And each individual development reinforces the others. Argentina and Brazil now trade in their own currencies. India and Russia settle transactions in rupees and rubles. China and Saudi Arabia discuss yuan-denominated oil sales. Any single one of these arrangements is small, but together they represent something significant. The gradual construction of a world that doesn't need the dollar quite as much as it used to. Now defenders of the current system will push back here. They'll say the dollar is too entrenched to be displaced. They'll point out that there's no single alternative currency ready to take its place. They'll note that China has its own economic problems. A stressed real estate sector, an aging population, slowing growth. And those points aren't wrong. The dollar isn't going to lose its reserve status tomorrow. There won't be a single dramatic moment where everything changes. But that's not how these shifts happen. They happen gradually, and then suddenly. For 50 years, the dollar's dominance seemed unshakable. Now, for the first time, countries have genuine alternatives. They have other places to hold reserves. They have other currencies to invoice trade. They have other payment systems to move money, and they're using them. So, let's talk about what this means for the United States. Right now, the US government runs massive budget deficits, trillions of dollars per year. Interest payments on the existing national debt now exceed $600 billion annually. That number keeps growing as interest rates rise. The United States is caught in what economists call a debt spiral. It has to borrow more each year just to cover interest on previous borrowing on top of all regular government spending. And if the traditional foreign buyers, China, Japan, oil exporters are reducing their purchases, someone else has to make up the difference. Who steps in when foreign demand drops? The Federal Reserve, America's central bank. When the Fed buys government debt, there's a technical term for it: debt monetization. In plain language, it means the government is essentially creating money to fund itself. We saw this happen on an enormous scale during the pandemic. The Federal Reserve's balance sheet expanded from under $4 trillion to over $9 trillion at its peak. More than $5 trillion created and used to purchase government debt. And what followed? The worst inflation in 40 years. Food prices jumped 20, 30, even 40% on some items. Gas prices surged. Rent costs climbed. Real wages adjusted for inflation, actually fell for most workers because pay raises couldn't keep up with rising prices. This is the hidden tax of money creation. When the government prints money to cover its deficits, it doesn't affect everyone equally. People who own assets, stocks, real estate, businesses see those asset values rise. People who depend on wages and savings see their purchasing power erode. So here's the bind the United States faces. If foreign buyers continue stepping back from Treasury bonds, the government has limited options. It can dramatically cut spending, which is politically almost impossible. It can raise taxes substantially, which is equally difficult. Or the Federal Reserve can keep monetizing the debt, which means more money creation, which means more inflation, which means your dollars buy less. There's no easy escape from this arithmetic. It's the accumulated consequence of decades of spending beyond our means. And let me be direct about something. This isn't just about numbers on a spreadsheet. This is about power. The dollar-based system has been the foundation of American global influence for over 50 years. It funds a military presence in over 80 countries. It enables sanctions regimes that can crush foreign economies. It allows the United States to maintain a defense budget larger than the next 10 countries combined. All of that rests on the dollar's special status. And if that status weakens, even gradually, the entire structure of American power becomes more fragile. I want to bring this back to your life because I know this can feel abstract. Bond markets, reserve currencies, central bank policy. These aren't things most people think about day to day, but the effects are real and they're coming. If the dollar loses purchasing power internationally, imported goods become more expensive. And in a globalized economy, almost everything has some imported component. Your phone, your car, your clothes, your food. In many cases, higher import costs mean higher prices at the register. If the government has to pay higher interest rates on its debt, there's less money available for everything else. That means pressure on education funding, infrastructure, healthcare programs, Social Security. The choices become painful. Either cut services or borrow even more, which makes the debt problem worse. If we enter a period of sustained inflation, the kind that erodes savings and makes planning impossible, household financial security becomes much harder to maintain. Retirement becomes less certain. Everyday expenses eat into what you can save. And if the global economy fractures into competing currency blocks, supply chains become less reliable. We've already seen glimpses of this during the pandemic. Shortages, delays, price spikes. A more fragmented world means more of those disruptions. I'm not trying to frighten you. I'm trying to prepare you. The world that many of us grew up in, where American economic dominance was simply assumed, where the dollar was unquestioned, where the consequences of overspending always seemed to land somewhere in the future. That world is transitioning into something different. The transition might be slow. It might take a decade or more, but the direction is increasingly clear. So, where does this go from here? I see 4 possible paths, and I want to lay them out honestly. The first path is managed decline. The United States accepts a multipolar economic world. The dollar remains important, but shares space with other currencies. This would require significant humility, a willingness to reform international institutions, to give rising powers more voice, to accept constraints on unilateral action. Based on current political dynamics, this seems unlikely. The second path is confrontation. The United States tries to force the world to maintain dollar dominance through pressure, more sanctions, more trade restrictions, more explicit use of financial power as a weapon. This is dangerous because it turns economic competition into geopolitical conflict, but it's not implausible. History shows that declining powers often reach for coercion when persuasion stops working. The third path is crisis. The current trajectory continues until something breaks. A failed Treasury auction, a spike in interest rates, a currency crisis. This would be the hard landing scenario. Financial markets freeze, the economy contracts sharply, and the adjustment happens all at once rather than gradually. Every year without meaningful reform makes this more possible. The fourth path, and I think this is the most likely, is fragmentation. The global system gradually splits into currency zones. A dollar zone centered on the United States and close allies. A yuan zone centered on China and its trading partners. Perhaps regional arrangements in other parts of the world. No single dramatic collapse, but a slow erosion of the unified system that existed before. None of these outcomes are certain. The future hasn't been written yet. But what I can tell you is that the assumptions of the past 50 years, the assumptions that America's financial position was unassailable, those assumptions are no longer safe. Before I close, let me leave you with 3 key points to remember. 1. China has removed over $500 billion from U.S. Treasury holdings, not in a panic, but through deliberate strategic rebalancing. This signals a fundamental shift in how major powers view dollar-denominated assets. 2. The freezing of Russian reserves in 2022 changed the calculation for every country that holds dollars. It demonstrated that those holdings exist at Washington's discretion. Countries are responding by diversifying into gold, into alternative currencies, into parallel financial systems. 3. The United States faces an impossible math problem. It needs buyers for its ever-growing debt. But the traditional buyers are stepping back. The alternatives, cutting spending, raising taxes, or printing money, all carry serious costs. There's no painless exit. What we're watching isn't a crisis that will resolve next month or next year. It's a structural shift that will reshape global economics for decades. And the sooner we understand it clearly, the better we can prepare for what's coming. I'd like to hear your perspective on this. Where do you think this leads? Are we witnessing the end of an era, or is this just a temporary adjustment? Join the conversation in the comments. I read every one, and many of your insights genuinely sharpen my own thinking. If this analysis helped you see the issue from a new angle, subscribe to the channel. My goal is to break down complex global events with clarity and respect for your intelligence. No hype, no jargon. Thanks for watching, and I'll see you in the next one.